Hey everybody, thanks for joining me. This is Matthew Jackson with Solid Wealth Advisors, and today's topic is understanding long-term care insurance. Today, I'm going to be sharing with you the PowerPoint presentation that I've been using for the better part of a decade to help people understand, number one, long-term care insurance, and number two, if it's even something for them. I want to start by saying that long-term care insurance, in my opinion, is probably one of the easiest types of insurance to understand regarding how to protect your assets. There's a lot of miscommunication out there that long-term care insurance is very difficult to understand. It's complicated, and trust me, after spending a half an hour with me today, you're going to have the 100% skinny on how you can buy long-term care insurance rather than be sold long-term care insurance. So let's get started. There's a few things that really put our industry on equal playing field when we are talking about carriers. You'll see from today's presentation that really all of the plans are almost exactly the same. There's just a few choices that you're going to be asked to make decisions on from any of the carriers that are offered out there in the marketplace. But what I'm sharing with you today, you can use in all 50 states in the United States. It's applicable to you. Even though I'm located here in Colorado, you can use this information for your benefits. So let's jump right in. The first congruency that puts all of the carriers on equal playing field is how you qualify to get paid. And today I'm talking about tax qualified long-term care insurance, and that's significant for you watching because as a tax-qualified long-term care insurance plan or policy holder, any of the benefits that you would receive from the insurance carrier are non-taxable as income. That's a big deal for you. It helps you to leverage all of the money that you may receive if you need long-term health care for your care, rather than having to pay tax on it and reduce it by 15 or up to over 33%. So that's a big deal because the government is turning a blind eye to this being a taxable event. Then the IRS said well over a decade ago that they are going to be the entity that sets the standards for how everybody who owns a tax-qualified long-term care insurance plan qualifies to receive benefits. And before I review this with you, I just want you to think of one of the common miscommunications about long-term care insurance that's out there, which is long-term care insurance is too hard to qualify for and they don't pay. That's a bunch of hogwash, and the reason why is because, as I said, we're going to review the two qualifications that you would be required to satisfy per the IRS, and that's all you have to do. So in the past, when I've read articles through Consumer Reports or some other magazines where people have complained about not receiving their payments or not receiving them on time, it's really only because they haven't certified that they need help with one or two of these qualifications that we're going to talk about. Having been in the long-term care insurance planning space since 2003, I will tell you from the carriers, they've paid over 98.5% of all claims that have ever been filed for. And if you have your stuff in order, the average claims turnaround time for many of the carriers is less than 30 days. So you just got to remember that you have to play by the rules, and the rules are really simple. So let's get started. The way that you qualify to get paid, and this is in every single corporate brochure, is really simple, is all you have to do is have a licensed healthcare professional certify that you need help with one of two things for at least 90 days. Your doctor, not the insurance companies, would be certifying this. And they would be certifying that he or she feels that you'll need help for at least 90 days with number one, 2 out of 6 activities of daily living, which would be bathing, eating, dressing, using the bathroom, transferring, or continence. It's pretty simple. Anything that involves mobility. Or the other thing that your physician would be certifying is that they believe that you'll need continual supervision within arm's reach due to Alzheimer's, dementia, senility, stroke, or any other type of cognitive impairment, or even a spinal cord injury. That's it. It's one or the other. You need help because of mobility problems, or you need help because of a cognitive impairment. So let's think about number one first here on the screen, which is needing help with activities of daily living. I'm going to give you a real life example because a lot of people assume that these policies can only be used if you get old, sick, or frail, and that's not the case. you can use these plans for accidents as well as illnesses. So I'll give you a good example. Years ago, I was working with a gentleman who loves to ski in the mountains of Colorado, enjoying a great day, stopped on one of the catwalks to have a sip of water, enjoy the view, and got blindsided by a young person on a snowboard, shattered his femur, broke his hip, horrible accident, had to have extensive surgeries. Because his physician felt that even though the surgery would be successful and this man was single and just had a major surgery, they certified that they thought that this fellow would need help for at least 90 days with 2 out of 6 activities of daily living through his recovery. When they did that, he was able to go on claim while he was recovering. He did fully recover, just simply dismissed the home health care person back to the agency, and he went back to live a normal, healthy life. So, myth number 1 that we're dispelling today is that you can only use these for when you get old, sick, and frail. That's not the case. Number 2, that these plans are use it or lose it plans. You can only use it once in your entire lifetime, and now you know that's not the truth either. You can turn these plans on and off again throughout your entire lifetime. And remember, it's your doctor certifying, not the insurance companies. Okay? Spinal cord injury on the second one. You have a spinal cord injury, need help for at least 90 days. You're going to be able to utilize your plan, and for any other cognitive impairment. I hope I did a good job of explaining it because it's really that simple, and what I just shared with you is in every single corporate brochure that you'll look at, okay? What's the second thing that's congruent with long-term care insurance, and that is what services are covered, okay? They all of the carriers out there as a standard feature cover home health care, adult daycare, assisted living care, nursing care, hospice care, and even respite care. And I don't know about you watching this video, but me, I can't think of anywhere else that you would have to go in order to receive long-term health care. And here's the really cool thing. You are in full control on where you decide with your doctor that you would like to be when you receive your care. So the carriers cannot tell you that you have to go to a facility. They cannot tell you that you have to go to an assisted living care facility or even receive home health care. And quite frankly, they don't care, and you'll see why here in a few more slides. Okay? That's it. It's pretty simple to understand. You can choose where you want to go, and it covers pretty much anywhere under the sun. All right? Here's the next thing that's congruent with all of the carriers, and that's in regards to your premiums. All right? Now, premiums in our industry typically remain the same or level, as we say in our industry, while the value of your policy grows over time. Now, I'll tell you the truth, which is there is not one single carrier in our industry that has a squeaky clean track record of never having rate increases. And quite honestly, I can't think, and I'm sure you can't either, of any item, good, or services that hasn't gone up in price over time. It's interesting to me how this industry and these plans got this connotation that when you buy one, the prices will never ever increase. That doesn't happen with our auto insurance, doesn't happen with our health insurance, homeowners insurance, and it's the same way with long-term care insurance. Now, it's important for you to understand that the carriers try as hard as they possibly can to keep the rates as stable as possible because they know that there's a small competition for business in this space, meaning there's not a lot of carriers to choose from. The pricing is very close with all of the carriers, and they do not want to hinder their ability to attract new clients. So they try to keep their rates as stable as possible. I will tell you that, if you are a policyholder, you should bank on a rate increase every 7 to 10 years. It may happen sooner, but that's kind of a general rule that I share with my clients, and I've helped hundreds and hundreds of people with their long-term care insurance plans. So I hope that makes sense. There's no rate guarantees, but they do a really good job at trying to keep them as stable as possible. All right, which is a really important reason that you want to pay attention as we go forward on how to design a plan that avoids over-insuring you and gives you the right dosage per your particular goals and your needs. All right, let's move on. Pretty simple stuff. The next thing that is congruent with all of the carriers is how you design a policy for you and your family. And it's super simple. They're just going to ask you these 4 things to choose from. And that is, what type of policy do you want? How much in benefits do you want to be paid on a monthly basis? How long do you want to be paid for measured in years? Okay. And do you want to protect your policy against inflation? And in my mind, that's a no-brainer. You have to do it. And you'll understand why here in just a little bit. Okay. So moving on, let's talk about the types of long-term care insurance policies that you can have. And you can either purchase an individual or a shared policy. And here's the difference. Husband and wife, same-sex couple, common law married people can choose to have a shared plan. And here's the analogy that I'll give you. If my wife and I were riding horses in the mountains of Colorado, and the horse that I'm on gets nervous while we're crossing a creek, I get bucked off, I fall into the creek, and I break my back, and I need long-term health care. Obviously, my policy benefits would pay for my care, but if I outlast the benefits inside of my policy, meaning I've exhausted all of the benefits that are due to me under the contract, but I still need care, with an individual plan, I have no choice but to try to qualify for Medicaid or spend my own money. Not the greatest position for me to be in with my family. However, if I have a shared plan, I fall off the back of the horse, land in the river with a broken back, and now I need long-term care, and I go through all the benefits in my long-term care insurance policy but still require care, my wife can now gift policy benefits out of her policy to me, in effect doubling my coverage, which brings up the question, well, what does your wife do then? Well, trust me, if I was receiving $7,000, $8,000, $9,000, $10,000 a month in long-term care insurance benefits, she would understand the benefits of buying another policy if she can to protect herself even more. Okay? Here's the other scenario that you need to be aware of. This works in death as well. We're riding in the backcountry of Colorado on horses, fall off the horse, break my back or my neck, and I die right there on the spot. With an individual policy, my policy simply goes away. My wife can continue to carry her policy, and she's only responsible to pay her premium. Sounds fair, right? But with a shared plan, the benefits are much better. Because if I predecease my wife, all of the policy benefits are now gifted to my spouse, in effect doubling her coverage, and she only has to pay one premium, not both. That's a big deal. So to tell you really honestly, every single couple that I've worked with since 2004 have a shared policy, and you need to have one too if you're in a relationship. Okay? So let's move on. The next thing that the carriers are going to ask you to choose is how much do you want to get paid on a monthly basis? And your choices are, you can receive as little as $1,500 per month or all the way up to $15,000 per month. And this is where people go completely wrong and they have no idea where to start or what type of benefit to choose for their situation. So I've got a really unique strategy to help you understand how to make those choices. And that is to utilize the idea of coinsurance. And so if the actual cost in your area is $7,000 per month for a private room in a nursing care facility, which that number is about average nationwide, you want to make sure that you research what the costs are in your area so you can plan appropriately. And I'll give you a really quick example. If you live in New York City and you plan on retiring in Mississippi, the costs for long-term care are completely different. If you're in New York City, the cost for care could be over $330 per day. If you're in Mississippi, the cost for care could be $120 per day. So if you plan on moving or living somewhere else in retirement, you want to try to plan your long-term care insurance plan for the needs for where you probably be living. So let's go back to our presentation here. So we're talking about the idea of utilizing coinsurance. If the cost of your care is $7,000 a month, I am not the type of person that recommends to anybody, even my wealthy clients that could afford to self-insure this out of their own pocket, I'd tell them, don't fully insure this plan. It's really expensive and it doesn't make sense. However, maybe it makes more sense for you to have a plan that covers 90% of the cost and maybe even less. So if we looked at that, your policy paid 90% or $6,300, you would be responsible for the difference that month of $700 for an out-of-pocket expense. And most people that are considering long-term health care insurance can afford to utilize that type of coinsurance. But let's roll it out a little bit more. You can also have a plan that pays 80% or 70% or even 50% of what the cost is for long-term care in your area. And I'll give you a really quick exercise on what I like to invite my clients to think about when we're designing how much coverage is appropriate for them. And that is, let's talk about your ideas as far as legacy planning for the future. This is a big deal. And for me and my private clients, long-term care insurance is nothing more than either number one, an asset protection play. They want to protect their assets against the high cost of long-term health care. Or two, they want to protect their family members from being the person responsible for providing the care. I mean, let's face it. I love my parents. I will help them if they need long-term health care. I personally don't want to be the one that has to change their clothes, take them to the bathroom, and do those types of personal things. I would feel much more comfortable if I could pay somebody to do those private things, and I know that my folks would like to have their dignity intact, not having me do it. But once my folks were started for the day, had their personal chores done, bathing, dressing, using the bathroom, those types of things, then I'm more than happy to take it from there. Meal preparation, anything else that they need, and I'm sure you're the same way. So let's talk about legacy planning. I have found, interviewing lots of people, that there's really two types of people that are out there that are considering long-term health care insurance, and they're very similar in one way, but they're very different in another. The way that they're similar is that they've worked hard through their adult life, they don't want to do without in their retirement, and they have a significant desire to pass assets beyond for a healthy spouse, kids, grandkids, favorite charity or religious organization. And many of those people already have defined contribution plans already in place for charity. If you're that type of person, you need to be considering long-term health care insurance. All right? And maybe you want more coverage between 70 and 90% worth of protection because that's the best way to protect the most assets. Does that make sense? So you have a significant desire to pass a legacy on for your family, you probably want to have this type of coverage. If you're the second type of person who has worked hard in their adult life, they don't want to do without in retirement, and you may not have a significant desire to pass assets beyond to a healthy spouse, kids, grandkids, favorite church, or favorite religious organization, and maybe you're just looking at long-term health care insurance to make sure that you're not a recipient of Medicaid, to maintain your freedom of choice, right? And to ensure that you have assets so you get the best quality care possible, then maybe you want a plan that pays 50% of the cost or up to 70% of the cost, okay? So don't be afraid to look at policies like these that don't cover everything. And that's probably the number one way that you're going to save money on your long-term care insurance premium. Unfortunately, I've had person after person after person into my office over the years who have brought quotes either from a captive agent or somebody who's really not a specialist in the long-term care insurance space, and the premiums are ridiculously expensive because the advisor doesn't understand the value of co-insuring in order to reduce premiums to an acceptable level. And remember, affordability is key because you're going to carry these policies throughout your entire lifetime until you need them. Okay? I hope I did a good job of explaining that. Let's move on to the next thing. The next thing that the carriers will ask you to choose from is what's called your benefit period, and that's measured in years at a minimum, not a maximum. And just hang with me for a couple moments because this will make sense here in just a second. So your choices to receive those monthly payments measured in years at a minimum are you could receive those payments for a minimum of 1 year or all the way up to 10. Now, my advice to you is because we don't have a crystal ball and we can't see what's in our future, let's play the odds. It's the smartest thing to do. So when we look at men and women, there's a little bit different care expectation as far as how long you might need care. Men on average, when they need care just about 3 years, a little bit under. Women on average, when they need care, need help for about 5 years, just a little bit under as well. Okay. I personally don't feel like there's any reason to have a policy that pays more than 7 years for a couple very good reasons. Number one, the Society of Actuaries and the claims departments of the carriers know, this is great information, that you have less than a 2% chance of needing long-term healthcare services beyond 7 years. And those people are typically Alzheimer's people or spinal cord injury people, and that's it. Okay? What's the other reason I would not recommend having care beyond 5 years? It's because of the Medicaid spend-down rules. Medicaid spend-down rules require us, as Americans trying to qualify for Medicaid, to submit the last 5 years of financial records. Because what they're looking for is that you have less than $2,000 or less of personal liquid assets, $500,000 or less of home equity. If you have anything more than that as an individual, you'll be required to spend all of your liquid assets down to only the $2,000 base to try to qualify for Medicaid. And if you're found that you're trying to gift assets away to try to look impoverished on paper, they're most likely going to find it, and which will exclude you from qualifying for Medicaid for the time period that the money that you were trying to gift away would have paid for your care. So it's important to understand Medicaid rules, because if we have a 5-year look-back period and you have 5 years worth of coverage, it would give you, if you're working with a experienced and knowledgeable professional and attorney, the ability to gift your assets away legally and still protect them against Medicaid spend down. So that's a big deal. Let's roll it out one more step further for people that are in a married or same-sex or Commonwealth law partnership. And that is, if you have a shared plan, I recommend you each have 3 years worth of coverage for a total of 6 that you would share. Because if one person dies without needing the care, the surviving spouse has a minimum of 6 years worth of coverage that they could use, thereby making it much more reasonable that they could gift some assets if they need to. And you can roll out the other experiences or situations beyond that. So my job as a long-term care insurance professional is to utilize all of the tax laws that are available and all of the laws regarding Medicaid to make the most robust but affordable plan for the client as possible, which is you. Okay? So if you're in a shared situation or a married couple situation, have a shared plan. Get 3 years worth of coverage for a minimum of 6. If you're an individual, have 3 or 5 years worth of coverage. So why do I keep saying measured in years at a minimum? Stick with me, because this is probably the most important thing that I'll share with you through this whole PowerPoint presentation. What I mean when we talk about years measured as the minimum is that what you're actually purchasing with a long-term care insurance plan is the ability to access cash. That's it. And the way that we determine how much cash is available to you inside of your policy is just a function of how much money you want to get paid on a monthly basis and how long you want to get paid that money for. So here's a quick example, and that is we take your monthly benefit amount by 12 months, sorry to be redundant, time your benefit period, and that's the value of your policy. So in this example, if you had a policy that paid $5,500 a month for 12 months and 6 years, your initial policy limit would be $396,000. It's a big deal. That means to you $396,000 as a firewall between the long-term care insurance facility or provider and your personal liquid assets. It's a big deal. So the reason why I keep saying that these policies last a minimum is because when we look at the bucket of money available to you, it's quite likely that this money would last longer than 6 years. And I'll give you a real life, really quick example. Most people, if they need long-term healthcare services, would rather receive those services at home in the comfort of their own recliner with their own refrigerator and their own TV and the carpet that they're used to, rather than going to a facility. So the care event for home health care, and we'll speak about Colorado where I live right now, the average cost for care is about $22 an hour. Well, if I was hiring somebody to come into the home for 2 hours in the morning and 2 hours in the evening to do personal care, use the bathroom, shower, change your clothes, same thing at night, then I only needed 4 hours worth of care that day. Over the course of 30 days, Okay, you're talking about 120 hours worth of care over the course of 30 days at $22 an hour. You guys can do the math. It's, over about $2,600, somewhere around there. Let's not split hairs. But your policy would reimburse you for the actual charges, which would be $2,600. But what if your policy paid a maximum of $5,500? As a reimbursement plan, you would receive the $2,600 for the expenses that you incurred, and the difference between the $5,500 and the $2,600 or $2,900 remaining would just simply remain in your benefits pool, thereby extending how long your coverage would last. And that's a big deal because remember, the doctors can't tell you where you have to go to receive care. You have freedom of choice. The insurance carriers can't tell you where you have to go, and therefore you can have some discernment on how you spend your money. So if you're frugal, you can make your coverage last, in this example, 7, 8, and even 9 years, depending on the type of care that you need. And remember, it's not use it or lose it, and you can turn it on and off again throughout your entire lifetime. Pretty cool stuff. Okay? I hope I did a good job of explaining that. Now, I want to spend a moment on partnership plans. You need to make sure that you verify in your state, which plans are partnership plan eligible. And here's what a partnership plan does, and I'll read it for you. Medicaid asset protection is a means of protecting a portion of your assets that you would otherwise have to utilize or spend down in order to determine eligibility for Medicaid benefits that continue to pay for your long-term health care. A partnership qualified policy enables policyholders to protect $1 of personal assets for every dollar the policy pays out in benefits. It's a big deal. The amount of an individual's Medicaid asset protection is equal to the sum of all benefits paid under the partnership qualified policy when he or she seeks to qualify for Medicaid. So let me put it into plain English for you, okay? Here's a real life example. If you had received $396,000 over the course of 6 years, the example that we're talking about, you will be able to shield the same amount of personal liquid assets for Medicaid spend down or Medicaid clawback rules and still qualify for Medicaid assistance rather than spending your own assets down. In this example, if you receive $396,000 in insurance benefits, you may be able to qualify for Medicaid and retain $396,000 of personal liquid assets and still be Medicaid eligible. That's a big deal because if you're trying to protect assets for the benefit of a healthy surviving spouse or people that you want to leave money to as a legacy, this is a big deal and it helps us to avoid over-insuring. Okay? So that's it. That's very simple, and this partnership protection really has been the genesis of a lot of my wealthy clients that could afford to self-insure this problem on their own to utilize a long-term care insurance plan. Okay, let's spend just a few more minutes on something that's very important that's you're probably all wondering, which is, well, how do I know a long-term care insurance plan is right for me? Well, you've got a couple options. You can either pay for long-term health care out of your own pocket, or you can transfer the risk to an insurance company, which I know seems very basic for me to say, but I'll share it to you this way. Many of my clients can't afford to self-insure a $300,000 or $400,000 problem on their own, but many choose not to. And here's how we know. If you own health insurance or you have Medicare, you're not the person who wants to spend $400,000 on a health event. You're not. And if your financial advisor, and I'm a financial advisor as well, a retirement planner, is telling you that you can self-insure this problem on your own, shame on them. Because they probably don't know. Maybe they haven't asked you what your intentions are regarding legacy planning. Maybe they haven't asked you that you wanted to buy that dream property and you had earmarked that money for that. Maybe they want to keep your money inside of the stock market so they can keep earning their commissions. Self-insuring against this problem to me is very, very risky, and here's why. When I started in this industry back in 2004, the U.S. General Accounting Office thought that we as Americans had a 40% chance of needing long-term healthcare services after age 65. You know what's changed? It's 2017. The U.S. General Accounting Office is now saying that they believe that when you turn age 65 in the United States of America, you have better than a 70% chance of needing some type of long-term health care services at some point during the rest of your life. Now, I know none of us ever think that we'll ever need long-term health care. But let me tell you, if you're wrong and you self-insure, the penalty could be hundreds and hundreds and hundreds of thousands of dollars. On the other side of the coin, if you buy a long-term care insurance policy and you're wrong and you never need a long-term health care, it could be tens of thousands of dollars that you paid in premium. You paid for peace of mind. What I recommend to my private clients that I do retirement planning for is to pay for your long-term care insurance with interest on savings. So if you're reinvesting your money into your brokerage account, simply peel off a little bit of that interest and let the interest that you're earning on your biggest asset, your retirement accounts, pay for the one wrapper that's going to protect this whole thing for yourself. I mean, let's face it. You haven't done without for 30 or 40 years working, eating peanut butter and jelly sandwiches at lunch instead of going out every day, maybe putting off buying that new car every 5 or every 10 years to save money for your retirement, only to undo it because you failed to make the proper decision and you let the odds get stacked against you. Good food for thought. That's all I'm going to say about it. I hope I did a good job of explaining to you the basics of long-term care insurance and you have a great understanding of how tax-qualified long-term care insurance works. If you need some help, you can contact me with questions at Matt, M-A-T-T, at Solid Wealth Advisors. I do recommend that you work with an independent broker that can shop these premiums for you because these premiums are age and health rated. And even though the coverages are exactly the same from carrier to carrier, the premiums do vary, and you could save yourself tens of thousands of dollars over the life of your contract just by shopping with an independent advisor. Okay? So if you have questions, you can contact me at Matt at Solid Wealth Advisors. Please do me a favor. If you liked this video, comment below, okay? And also subscribe because we'll send you more free video content to help you become a more educated investor, help you to make smarter decisions about your future in retirement. And remember, the reason why we do what we do is because we want to see good, hardworking people just like you have the most fulfillment in health, wellness, and happiness during your retirement. Go out there, make it a great day, do your best. Look for our next video. Have a great day.